How to become a stockbroker. Personal finance. Personal finance is one of the basic courses that students can take before moving on to more advanced stock market classes. Here are a few areas that a person must learn in order to become a stockbroker. Financial management. Financial management is the process of planning, organizing, directing, and controlling an organization's financial resources. It involves making strategic decisions that ensure the financial health of a company, including managing investments, creating and implementing financial policies, analyzing financial statements and reports, monitoring cash flow, and managing risks. The goal of financial management is to maximize profits and increase the value of the organization by making sound financial decisions. This includes managing financial resources to achieve strategic goals, optimizing capital structure, managing financial risks, and making sure that the organization is in compliance with financial regulations. Effective financial management requires an understanding of accounting, economics, and financial markets. It is a critical component of running a successful business and involves both short-term and long-term planning and decision-making. Corporate finance. Corporate finance is the branch of finance that deals with the financial decisions and strategies made by corporations and their managers in order to maximize the value of the firm for its shareholders. It involves the study of how corporations raise and allocate funds for various projects and investments, as well as how they manage their financial resources and mitigate risks. Some of the key areas of corporate finance include financial analysis, capital budgeting, financing decisions, dividend policy, and risk management. Corporate finance professionals may work in a variety of roles, such as investment bankers, financial analysts, corporate treasurers, or CFOs, chief financial officers. Investment management. Investment management is the professional management of financial assets, such as stocks, bonds, real estate, and other securities, with the aim of achieving a specific financial objective. Investment management involves making decisions about how to allocate money among different asset classes and investment opportunities in order to maximize returns while minimizing risk. The process of investment management typically involves analyzing market trends and economic conditions, identifying potential investment opportunities, conducting research on individual securities, and making investment decisions based on an investor's goals, risk tolerance, and time horizon. Investment managers may use a variety of investment strategies, such as value investing, growth investing, income investing, and index investing, among others. Investment management services are often provided by professional money managers, such as investment advisors, portfolio managers, and mutual fund managers. These professionals may work for financial institutions, asset management firms, or as independent advisors, and they may manage investments for individuals, corporations, pension funds, and other institutional investors. Investment analysis. Investment analysis is the process of evaluating the potential performance and risk of an investment opportunity in order to make an informed investment decision. The goal of investment analysis is to identify investments that offer a good balance of risk and return and are consistent with an investor's financial objectives and risk tolerance. Investment analysis involves a variety of techniques and methods, including financial modeling, ratio analysis, and qualitative analysis. Financial modeling involves using financial data and forecasting techniques to estimate future cash flows and investment returns. Ratio analysis involves examining financial ratios, such as the price-to-earnings ratio or return on equity, to assess the financial health of a company or investment opportunity. Qualitative analysis involves assessing non-financial factors, such as the quality of management, the competitive landscape, and the regulatory environment, that may impact the performance of an investment. The process of investment analysis may be performed by individual investors, financial advisors, or professional investment analysts. It is a key part of the investment decision-making process, helping investors to identify and select investment opportunities that are consistent with their financial goals and risk tolerance. Derivatives. Derivatives are financial instruments whose value is based on an underlying asset, such as a stock, bond, commodity, currency, or index. They are called derivatives because their value is derived from the value of the underlying asset. There are many different types of derivatives, including futures contracts, options, swaps, and forwards. Futures contracts are agreements to buy or sell an underlying asset at a specified price and date in the future. Options are contracts that give the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price and date in the future. Swaps are agreements between two parties to exchange cash flows based on the value of an underlying asset, while forwards are agreements to buy or sell an underlying asset at a future date at a price agreed upon today. Derivatives are used for a variety of purposes, such as hedging against risk, speculating on future price movements, and accessing otherwise unavailable investment opportunities. They are widely used in financial markets by investors, traders, and institutions, and are often used to manage risk and increase returns in investment portfolios. However, derivatives can be complex financial instruments and may involve significant risks, including the potential for large losses. It is important to understand the risks and benefits of derivatives and to use them appropriately based on an individual's financial situation, investment goals, and risk tolerance. Macroeconomics. Macroeconomics is the branch of economics that studies the behavior and performance of an economy as a whole, rather than focusing on individual markets or specific economic agents. It is concerned with understanding and analyzing the overall trends and movements in key economic variables such as GDP, gross domestic product, inflation, unemployment, interest rates, and exchange rates. Macroeconomics seeks to answer questions about the overall health and stability of an economy, as well as the factors that influence economic growth and the distribution of resources in a society. Key topics in macroeconomics include economic growth, business cycles, fiscal policy, monetary policy, and international trade. One of the primary goals of macroeconomic analysis is to help policymakers make informed decisions about how to manage the economy in order to achieve certain economic outcomes, such as low unemployment, stable prices, and sustained economic growth. Macroeconomic models and theories help policymakers to better understand how the economy functions and how it responds to various policy measures. Macroeconomics is a complex and constantly evolving field of study, and it is essential to have a good understanding of the basic concepts and principles of macroeconomics in order to analyze and interpret economic data and trends. Behavioral finance. Behavioral finance is a branch of finance that applies psychological and behavioral theories to understand and explain financial decision-making by individuals, institutions, and markets. It examines how emotions, cognitive biases, and other psychological factors influence financial decisions and market outcomes. Behavioral finance challenges the traditional economic assumption that individuals always act rationally and with perfect information. Instead, it recognizes that people are subject to a range of cognitive biases and heuristics that can impact their financial decision-making, such as overconfidence, loss aversion, anchoring, and herd mentality. These biases can lead to irrational behavior and affect the pricing and efficiency of financial markets. Behavioral finance research has contributed to the development of several key concepts, such as prospect theory, which explains how people make decisions under risk and uncertainty, and the disposition effect, which describes the tendency of investors to hold on to losing investments too long and sell winning investments too soon. The insights of behavioral finance have practical implications for financial advisors, portfolio managers, and individual investors, as they can use this knowledge to better understand and manage the psychological factors that affect financial decisions. They can also use this knowledge to design investment strategies that align with an individual's cognitive biases and emotional tendencies in order to optimize investment outcomes. Please subscribe for more content.